Good afternoon and good morning for those on the other side of the Atlantic. Thank you for joining us for the latest McGill and Partners webinar, Navigating the Cyber Insurance Labyrinth. For those on the outside of the cyber insurance market, it can be a confusing space. It's an area of insurance that's seemingly filled with technical jargon and inconsistent policy wordings, and coupled with fast evolving coverages and ever-changing threat landscape. It's hard to keep up. There's often a lot for any modern business to think about when it comes to cyber risk, be that how you're looking after and using your data, protecting your network and day-to-day operations from threats outside and inside the business, or more recently and worryingly, even your physical property. So over the course of the next hour, we're going to look to address some of the key areas currently troubling cyber insurance buyers and even the insurers themselves, and hopefully look to provide you with some food for thought and action points to set you on the right path when looking at covering your cyber exposure. So I'm Tom Dryden from McGill and Partners, and I'll be moderating today's session. And I'm really pleased to have a fantastic panel with me who are well versed in the murky waters of cyber insurance to unpick some of these issues facing the market today. So we have Ben Hobby. Ben is a partner from Baker Tilly and an expert in the adjustment investigation of cyber claims, with a focus on business interruption. Ben also sits on the Cyber Claims Committee for the IUA. We have Mark Camillo. Mark heads up cyber for AIG for the EMEA region, and before that led the US cyber team for AIG. And finally, we have Nuno Barlow, head of financial lines claims for McGill and Partners, previously head of UK claims for AIG and international financial lines claims before joining McGill and Partners earlier in the year. So we have quite a fair bit to cover in a short space of time. But we would love to take some any questions that you might have crop up throughout the session. So please make use of the question and answer function to submit any questions that might arise, and we'll aim to respond to as many as well at the end of the session. But just before we launch into discussion, I'd like to ask you, the audience, a question, if that's all right. So we brought up the poll there. The question is, following the events of the last 4 months, the global pandemic, my cyber insurance limit or interest in cyber is likely to increase? You feel you're more exposed, perhaps with more reliance on technology. Decrease, you simply don't have the budget anymore, or unchanged, stay the same. So increase, decrease, or stay the same. Just give you a couple of seconds to answer there. And if we could bring up the results. So a quite overwhelming 74% feel you are more exposed following the last 4 months, which is positive news, I guess, for the cyber insurance market. Perhaps not what we might have expected, perhaps, but so overwhelmingly. Nuno, I don't know if you have any comments on that result there.
Yeah, I'm very pleased to see that result. We did ask the question because we were concerned that people might start seeing cyber as kind of a luxury product, particularly given that other lines of business like D&O, the costs are increasing so dramatically there. And if you have just a limited budget for all of your insurances, if you're going to cut somewhere, we were worried that cyber was going to be one of those areas. But I think that is a really positive outcome, because I think people are becoming more and more exposed. And I think we'll hear that as we go on through the discussion.
Ben, I know your views tend to err on the side of cyber being a key part. Is that what you were expecting?
I was in two minds. I wasn't entirely sure what was going to come from that. Although I am, like Nuno, pleased with the outcome. I think, if anything, the events of the last few months have taught us just how dependent we are on IT working. We wouldn't be able to do today's session without some of the steps that have been made in IT technology over the last couple of years. So I think it's pleasing that the audience are aware of those issues.
Great. Well, yeah, that is really pleasing that a good proportion feel cyber is a core part of any insurance portfolio. But I suppose one recent challenge that does face buyers of cyber insurance is not just ensuring you are purchasing cyber cover, but I suppose the right kind of cyber cover, be that blended into a traditional line or a standalone cyber insurance product. And that's something that's a particular challenge at the moment following this year's sort of PRA and Lloyd's mandate on silent cyber, which is perhaps something you've read about or heard from your broker on, But what do we really mean by non-affirmative cyber? So silent cyber or non-affirmative cyber, as it's sometimes known, is where you have potential cyber exposures within a traditional property or liability insurance policy, which may not implicitly include or exclude cyber risk, but theoretically could pay claims for cyber losses under certain circumstances. And this inadvertent coverage for cyber exposures leads to potential problems for the industry and for policyholders, be that sort of risk exposure is not adequately reflected in pricing of that traditional line, perhaps coverage disputes in the case of Mondelez Zurich disputes where following the NotPetya claim against Mondelez property policy, or aggregation of silent risk causing potential systemic issues for the wider insurance market. So following a sort of lengthy review process from the PRA, which up to January of last year, the PRA issued a letter to insurers requesting that they reduce unintended exposure that might be caused by non-affirmative cyber cover. This followed a bulletin from Lloyd's in July of last year with a requirement for clarity and cover around cyber risk and instructions for insurers to either affirmatively include or exclude cyber coverage. This came into force, this sort of mandate came into force at the start of this year, with the first phase of insurances being sort of focused around the first party property damages. And since then, we've seen the phases roll out and actions from insurers being to sort of clarify coverage within their traditional lines. And this creates, I guess, certain challenges for policyholders. We've seen sort of inconsistent responses from insurers, be that to sort of go the full hog and exclude cyber or pare back cyber, but there's been a variety of responses across both insurers and lines. And the overall message has been, from what we've seen, is that insurers tend to be leaning towards this exclusion of cyber rather than affirming coverage. So sort of just to delve that bit deeper, Mark, perhaps you could give us a perspective on firstly how AIG have approached this and perhaps what insurers should be looking at to respond to the silent cyber issue.
Yeah, no, sure. No, thanks, Tom. I think that, this is an initiative that AIG has been looking at for a number of years. When we first introduced cyber back, over 20 years ago, we were really looking to cover the gaps that we perceived in the traditional property and casualty coverages. So it's really designed to cover kind of that non-physical exposure that now became prevalent as more and more companies moved to the internet. But about 6 years ago, we realized that cyber really is a peril that could stretch across almost every line of insurance that we write. And we sort of proactively came out with affirmative cover for cyber physical, whether that's bodily injury, property damage, working with our property teams and our casualty teams, for those clients that wanted at that time to ensure that they had coverage for those specific events. Now, obviously, from a regulatory perspective, that has heightened the awareness across the industry and has maybe escalated and made the industry move a little quicker in that regard. But because we've been working on it for so long, our mantra is we want to make sure we're underwriting, charging, and coding for cyber risk, regardless of the policy. So, for example, on a property policy, if we're intending to pick up that property damage, then we would exclude all other cyber non-physical events, but carve it back and then cover that physical damage. Similar on the casualty side as well. If the intention is there to potentially cover the non-physical in another policy, then again, we can do that. And we have underwriters that can work across the organization to create a solution that works for the client. But again, what we don't want is for there to be unintended cyber, which you may have seen the last few years where it crept into other policies. We just want to make sure that we're absolutely sure. And that's partly, from an aggregation perspective, so we can manage the exposure across the portfolio. We can report back to the board what both the physical and the non-physical exposure is. But I think what's really important for insureds is that it's really going to vary depending upon the industry that they're in, the size of the company. So if you're a retailer, your cyber risk or exposure could look much different than a manufacturer. And what we see the clients are the most success are those that are able to go through and actually identify those scenarios that they're most concerned about. Are those physical or non-physical cyber? Is it first party, losses to their own, or third party losses to others? And then mapping out their entire insurance portfolio and lining that up against that 4-quadrant grid, and then determining, where there's clear coverage, where there are clear exclusions, where there's a gray area, and then, working with your broker to identify and hopefully address some of those areas.
Great, thanks, Mark. And Ben, sort of from the claims perspective, have you seen any real life examples where perhaps a cyber incident has crossed the boundaries of this sort of physical damage, non-physical damage side of things? And I guess building on what Mark said, how would you recommend insurers approach this issue?
I think to the first part of your question, Tom, not yet. That's not to say that it won't happen. I think back to my earlier comments, we're more dependent upon IT nowadays. So I can see a cyber proximate cause event resulting in in physical damage. We're just yet to see it. I think what we are seeing though are within cyber claims are certain heads of claim that are more sort of physical damage related, where the proximate cause is definitely the cyber event. So if we take stock, for example, let's just take the example of say a yogurt manufacturer. Obviously, you're needing a lot of milk to come in to make that product. The manufacturing process is taken down because of a cyber event, but that milk is still coming in, and because of the fact it has a short shelf life, you've then got to do something with it. Otherwise, you're going to be making very, very different products. That act of destroying that stock, both in terms of transporting it off-site and also safely disposing it, the proximate cause of those costs undoubtedly is going to be the cyber event. But because we're concerned here with a physical item in terms of the stock and the destruction of it, depending on the policy wording, it's probably not going to be covered. I think just to kind of build on also what Mark was saying, though, the key to kind of dealing with these types of issues is scenario modeling. What types of loss may an insured actually occur? What are the financial consequences of that, and match those individual loss categories to the overall insurance program. So if there are gaps in cover, they're identified before there is a loss, because if you're trying to identify and deal with these gaps during a claim scenario, that's inevitably going to be a lot harder for everybody to deal with.
Yeah, absolutely. So I suppose the message there from both Mark and Ben is that when we're seeing these exclusions applied, perhaps traditional lines, is to take a step back and work cross lines to identify any gaps in cover that might arise and align those with your exposures that need identifying too. I suppose probably the insurance industry is traditionally quite guilty of siloing types of risk, as it sometimes has to, but certainly when it comes to cyber risk and how we're going to look at that going forward, it does need a coming together of some of these teams to make sure we're appropriately identifying gaps in cover. It's probably timely to mention as well, I guess, the FCA case, the financial regulator in the UK here against insurers at the moment in relation to with pandemic coverage and business interruption policies, but it probably sort of highlights the UK regulators' focus on looking to achieve sort of total clarity and coverage, building on what the PRA has been doing in cyber. And it might be interesting to see as this case unfolds, broader effects on perhaps other lines of business, such as cyber BI. So sort of on the topic of pandemic, I guess we'd be remiss not to talk about what has been occurring in the last few months, and it has wide-ranging effects on all walks of life. But cybersecurity is obviously no different to that. And as with any crisis, we've seen headlines talk of a proliferation in opportunistic COVID-related scams, such as the statement from the NCSC there on screen, and combined as well as you already mentioned, Ben, sort of this almost overnight shift to rely on technology and IT infrastructure. So sort of, Mark, given what's been going on in the last few months, what's your perspective from an underwriting point of view? Has there been a change in perhaps focus that underwriters are looking at, but also any claims, I guess, that you're seeing emanate from this?
Yeah, I would say from a claim perspective, there hasn't been a sort of noticeable increase since this began. But I would say that, that being said, the last, 18 months or so, there's been a significant increase in activity across the board, and that's primarily driven by ransomware. So although again we are seeing the level of attacks remain primarily the same. So for example, there may still be the same amount of phishing attacks that we typically would see, but they're using the situation as the lure, right? I think in this particular time, people are eager. They want information about it. So that if you can craft the message, because again, one way that the bad guys are that use regularly to gain access or gain initial foothold in the organization is through those phishing attempts, and that's regardless of the time of the year, right? On Valentine's Day, you see more Valentine's Day related emails that go out. During Champions League, you'll see those. So that's not surprising that again that they're changing the lure to try to get their users to click on that, to click on those links. But I would say again, from a claim perspective, what's been troubling has been the significant rise in ransomware related claims. I mean, we had ransomware has always been an issue, even going back a few years ago, but the difference is now it's more about the big game hunting, in the sense that they're now sitting on the network for an extended period of time, really understanding how the organization works, how do they back up their files, and they're then, once they've either deleted or encrypted the backups, then they're encrypting the entire system, and now they're asking for significant demand. So in the past, where it might have just been maybe a few €1,000, I mean, now you're seeing that millions of pounds, millions of euros, and starting off in the initial extortion. So again, that's been troubling from our perspective. And again, we don't necessarily see a decrease in that, right? So claim activity last year was up about 40% from the year prior, and that's just talking about UK, Europe, Middle East, and Africa was up about 40%. Our claims team is dealing with 3 to 4 incidents per business day, which is a little bit less than the US. They still get about 5 to 6 per business day, but that is the growing trend. And regardless of what we're seeing now and the environment, we do expect that to continue.
Great. Ben, is that your perspective as well, from sort of claims emanating from COVID? And how do you perhaps see that changing as we sort of obviously emerge from lockdown now and things change slightly from a sort of day-to-day basis?
Yeah, I mean, I think one of the biggest concerns is obviously that the last time we had a financial recession, like going back 2008, we did see a spike in activity. So the longer this goes, you do tend to see a rise in incidents, and it also kind of trends from social behavior. When you look at the crime side, for example, we tend to see internal actors that will capitalize on that. We always call, look, whenever that happens, look for the 9 Ds, right? So it's death, disease, drink, dice, drugs, divorce, dalliance or affair, debt, or disgruntled, right? And when you have a situation like this, you definitely have to look at the insider threat. Again, the longer this goes, where again, cyber has always been viewed as kind of that victimless crime, right? Where you're not actually, where the bad guys don't necessarily feel like they're harming anybody. And so again, that continues to exacerbate the problem. And again, as you have more financial difficulty, we would expect to see a further increase in claim activity.
Great, thanks. And Ben, is that your perspective as well?
I'm impressed Mark was able to remember the 9 Ds there. That was that was quite very impressive. I think from a claims point of view, related to COVID and cyber, we're not yet seeing the increase in claims that I think everybody expected when lockdown started in March. My view on that, I think, is that from a hacker's point of view, and to Mark's point, they're going to stay, once they gain access to a network, they are going to stay in there for a period of time to find out as much as they can, so that they can wreak the maximum amount of damage possible. But also then to increase their chances of actually getting the ransom paid. For a lot of companies where their trading reduced significantly immediately post-lockdown, a ransomware attack there wasn't going to cause as much economic damage to a business as it would do if it starts to happen now as a business comes out of lockdown. So if you're a hacker, when are you going to deploy the ransomware? When you're going to cause maximum damage? When you're going to increase the chances of actually getting paid? So while we've not seen that spike in claims yet, I don't think we're out of the woods yet, because there's a lot of businesses out there that are just starting to trade again, just starting to get cash in the business. And if those green shoots for those businesses are kind of nipped in the bud, then that's going to have a very significant impact on them and increase the chances potentially for hackers of getting ransom paid. So as I say, I don't think we're out of the woods yet.
Okay. Nuala, sort of anything to add there on the COVID side of things?
No, I think Mark and Ben have covered it off really well. I do like this slide though, because it's a great example of how hackers work and often can't spell, because you'll see that says enter your postcode to apply for COVID-19 relief rather than relief. But just a practical tip, for those companies who are unfortunate enough to have to be making people redundant, there's a really important factor to recover devices that your employees might have, so laptops or phones, and also make sure that you're shutting down their access to your systems. We don't see a lot of claims from disgruntled employees, but you can envision in this particular scenario where emotions are really running high, that the potential for claims by disgruntled employees might arise. So it's better to be safe than sorry.
Great. And still sort of on the topic of COVID-19, I guess sort of one potential fallout we might see as countries start to emerge from lockdown is in an effort to support governments to track and trace efforts, businesses, perhaps mostly customer-facing businesses, but also those businesses looking carefully at their employee bases, is starting to collect sort of increased volumes or different types of sensitive customer information and employee information to support those track and trace efforts. Nuala, do you have any sort of comments on, I guess, the potential pitfalls of this additional data protection?
Yeah, and I think it's in this particular scenario where, as you say, we've got restaurants and pubs potentially now starting to be data collectors. So when you go in, either through OpenTable and you're making your reservation, or they're writing down your name as you walk through the door. And so these are what are sort of considered inexperienced data collectors. They might not actually know what the rules are because they're not used to doing it. And unfortunately, I think the Information Commissioner, the UK regulator, is probably not going to be particularly forgiving. I think they have expressed some sympathy for these inexperienced data collectors, but have basically reiterated these 6 rules and said you have to follow these rules, even if you aren't used to doing it. You have to do it properly. And I do think there is the potential for the regulator to be quite definitive in enforcing these rules in the future.
Yeah, that's a very good point. And I guess sort of from a practical sort of policy language perspective, it is worth, if you are a business sort of with this additional data protection burden of collecting unusual customer information that you're perhaps not used to, is to check the language in your cyber policy. Firstly, I guess the trigger to the data protection liability coverage. Making sure that it doesn't just cover a breach of data, an actual sort of loss of data, but also the wider regulatory requirements such as wrongful collection or use of data, because you don't want perhaps untrained staff using that data in the wrong way. And also I can speak for itself, but check the exclusionary language. So a well-drafted cyber policy at the moment shouldn't be kicking out any claims of sort of wrongful collection type incidents, but these are 2 real life examples from policy wordings out there that do, so it's worth bearing in mind. So I guess just sort of staying on the topic of privacy and data protection, something that happened recently was GDPR, which we have all in the past heard a lot about. It's turned 2 years old, and CCPA, the privacy regulation in California, is now enforceable as of July. As well as sort of seeing evolving privacy regulations across the globe. So sort of Mark, I guess just looking back on the last 2 years of GDPR, perhaps you could just comment on has the enforcement and the level of enforcement been what you expect, and how do you sort of potentially see that unfold going forward?
Mm-hmm. Well, it's interesting because I think, the fact that we are 2 years in, I think we would have expected to have a little more clarity as to, when there is an event, sort of what to expect, right? That there'd be some sort of consistency across the different countries, depending upon the incident, there was going to be some sort of coordinated effort. And if ultimately there was some sort of, fine or penalty, that there would be some sort of, consistent logic that was being used across the country as well. And, what we're seeing is that it really varies by country, and not necessarily even the regulatory enforcement, but I would also say, just sort of culturally, how different countries are, even dealing with the GDPR. So as an example, we looked at our last, claims data. We had roughly the same number of claims in Ireland and in Spain. And in Ireland, in that number of incidents, almost 50% were actually reported to the data regulator. But in Spain, there were less than 5% that were reported. So you see this sort of big difference between just what's happening between North and South Europe. And when you look at the numbers of reported cases, that also bears out. And I think what's not on here, again, these are just sort of the imposed fines and penalties. Obviously, there's also a couple of large ones that are in the UK that haven't made this list because they were an intention to fine and not necessarily an actual fine. And there's still quite a bit of back and forth in terms of, and there's really some uncertainty as to what that ultimate amount is going to be. And again, I think that's concerning for a lot of clients because again, you could have a similar type of major cart event where they're siphoning off credit card data, and you could see a regulator in Germany dealing with that completely different than the regulator in the UK. And so that's something that we're going to continue to keep an eye on, seeing if as we as we're 2 years in, if over time if we get more clarity on that. But that's something that we're hoping for. Obviously, it's easier to price that coverage accordingly, but also for our insurers in terms of how they deal with these when these incidents do come in.
Nuna, from your point of view, I mean, you have perhaps experienced firsthand some of the breaches that might have resulted in some of these fines. Have you seen with the level of enforcement again what you'd expect, or perhaps not so strict as it initially, when we had the first headline figures sort of thrown out, had expected?
I think there was a period of time from May 2018 when the GDPR was brought in that maybe we were lulled into a false sense of security because it took the regulators quite some time. But once they started to impose fines, they are substantial and quite worrying. Just as a reminder, and I'm sure you all know this, but the GDPR provides regulators with the ability to fine a company either 20 million euros or up to 4% of its global turnover, whichever is the higher amount. So quite substantial fines. And by way of example, you'll see on the slide that's in front of you, France, it says 51 million euros in that period of time. Well, that's actually that's just basically one fine, the 50 million euro fine that was imposed against Google. That Google appealed against that fine, and it was very recently upheld by the French regulator. And in that circumstance, Google was fined because it failed to provide sufficient information to users about the data it was collecting in order to personalize ads. As you know, when you go on the internet, a lot of times you get ads popping up and you think, oh, I was just shopping for that or something like that. Those are the personalized ads. So it was related to that, and the allegation was that Google didn't provide enough information about its data consent policies and also didn't give the users enough control. So that 50 million fine, quite a substantial one, obviously. And then, of course, as Mark says, we've got the two fines in the UK that are bubbling along right now. The fine against British Airways for its data breach, which is the British Airways fine is, I believe, £183 million. And I think that's about 1.5% of British Airways revenue. And there's a fine against Marriott for £99 million, which is about 2.5% of its revenue. As Mark says, the most important thing to remember is these aren't actually fines that have been imposed. The regulator has expressed an intention to impose these fines. And both British Airways and Marriott, I believe, have made representations, as is their right, to say, hey, these fines are kind of totally disproportionate to the level of breach that we had. I do think it does seem that the regulators, the Information Commissioner here in the UK included, seem to be making very definitive and actually quite aggressive statements about how they're going to deal with these breaches going forward. The interesting one to watch coming up will be EasyJet. As many of you know, EasyJet had a breach earlier this year that involved apparently 9 million customers, the personal data of 9 million customers. If you think that the British Airways customer base was about 500,000 who were impacted, 9 million is substantially more. So query whether the regulator will impose a much stricter fine on EasyJet, or also whether and I'm not sure it'll make a difference, it's just something to add into the mix, whether the current kind of distressed state of the airline industry may have some impact on that fine.
Right, we have had a couple of questions come in on the insurability of these GDPR fines, which we might as well address now. Mark, perhaps turning to you, to the best of your knowledge, has an insurer been asked to pay one yet, and are they insurable? Are you able to answer that for the audience?
Yeah, I think that you know, at this point there's still a lot of uncertainty around the insurability of the fines or penalties. I think that, you know, we know that if it's sort of criminal in nature or designed to be punitive, you know, that's generally against public policy in order to pay that fine or penalty. Where there's a gray area is whether or not it's deemed to be sort of an administrative type fine or penalty, and that's really going to depend upon each, you know, the circumstances of each case. You know, what were the factors that went into determining the fine or penalty? What is that, you know, quantum in terms of what sort of, you know, sets it aside from being more of an administrative type of fine or penalty versus a punitive fine or penalty. So that's still being worked through. I mean, there's still a few, you know, case studies that are out there that, again, even if they are resolved, it may not set, you know, for the broader picture, because it sort of, again, varies by country, and it's really going to vary by you know, the circumstances of each case.
And what would be helpful that unfortunately hasn't happened is if the regulator would come down, would take a stand. So for instance, the Financial Conduct Authority has said unequivocally that any fines and penalties that it imposes are not insurable by law. And I suppose it would just be helpful for the industry as a whole, for clients as a whole, to know one way or the other, if, for instance, if the Information Commissioner came down and said that, but they haven't taken a position at all.
Yeah, absolutely. So we sort of mentioned it slightly already, but ransomware is something that obviously does dominate the headlines at the moment. As Mark has pointed out earlier, it feels like it's been a trend in cyber insurance for several years now, but we do have this continuing sort of evolution in complexity of ransomware attacks. And it's probably fair to say it's a large driver in some of the rising loss ratios across cyber insurance in recent months. So perhaps, Nuno, for the benefit of the audience here, perhaps you could just explain what ransomware is, what happens when you see a lock screen like that on the screen there, and how attacks have evolved recently.
And I imagine for many of you who've heard cyber webinars before, you're probably rolling your eyes and saying, oh my God, not ransomware again, because it is the subject of discussion on every single cyber webinar ever. But that probably is because it's such a dominant cause of claims in the market, and it continues to be a problem. So very basically, it is malicious software that is put on your computer, and usually, historically, what would happen is the bad actors would encrypt your data and then send you something that looked like the previous screen and say, pay a ransom and we'll give you your data back. Since then, the hackers, the bad actors, have actually discovered that ransomware and cyber extortion is a really lucrative business. And unfortunately, therefore, we've seen them become much more creative and much more enthusiastic about ways of getting money out of this process. It used to be a kind of a highly commoditized, very mass market approach. And the ransoms, as Mark said a little while ago, were very low. But unfortunately, that's all changing. We've started to see ransomware as a service. So using a very traditional business model, if you're so inclined, you can actually just go onto the dark web, and if you know how to get onto the dark web, and buy or rent malware kits that are very easy to use. So you can launch your own cyber attack. The volume of cyber attacks are increasing, incident response costs are increasing, and the ransoms themselves are increasing. There's an organization called Net Diligence, which does studies about cyber claims in the US, and they recorded a fourfold increase in ransoms between 2014 and 2019. And as this slide shows you, although professional services, the healthcare is primarily in the US, obviously, but professional services is really at the top of the industry pool for targets by ransomware. The reality is there's no industry that is exempt. Every industry could potentially be impacted by a ransomware attack. And the other interesting thing and worrisome thing that is happening is something that also Mark referenced earlier, is this change in approach. So it used to be hackers would just go in, encrypt your data, you would pay a ransom, hopefully get your data back. Now what they're doing is they're getting into your system, often through a phishing email. An employee click on a phishing email, and they're just hanging out there for a while, looking around to see what they can find, what interesting data that you have. They may try to actually encrypt your backups, so that would prevent you from restoring your systems through your own backup, which would force you to pay the ransom. But they're also doing things like looking for stuff that may have other values, so intellectual property, or information that could be embarrassing to the organization, and then they're threatening to disclose that. They're taking it, exfiltrating it from your system and threatening to put it on the internet. Which presumably would give them better access to the potential for a ransom, because you may not want to pay a ransom, because if you have good backups and you can back up, you don't have to pay the ransom. But if you're threatened with the loss of highly valuable intellectual property, you may be way more willing to pay the ransom. There is the ongoing debate about whether you should pay a ransom. The law enforcement organizations say you absolutely shouldn't pay a ransom, since there's no guarantee that you'll get your data back, because if you're paying a ransom, you're essentially relying on the integrity of criminals to get your information back. But many companies do pay in order to restore their systems, to decent operating levels as soon as possible. The good news is that many aspects of a ransomware claim, including often the ransom itself, are covered under a cyber insurance policy. But the bad news, as I say, is just it's a really successful business model for the bad actors. So I expect we're going to see a continued growth in this area.
Great, thanks, Luna. And Ben, I imagine, given sort of disruption from a business interruption point of view that ransomware can cause, I imagine you've seen quite a few of these instances. Do you have any insight into, I guess, sort of what goes well in terms of responding to a ransomware attack?
I think, as with any of these, any type of class of insurance, is a lot of it is down to the prevention work. I think, and Nuna's already highlighted the fact that good backups are a key thing. But before I get on to the backups, I think it's important to emphasise that paying the ransom itself, that does not always mean that the immediate issue has been solved, because you're not guaranteed to get your data decrypted necessarily, although there is a certain element of honorability amongst hackers, and given this is a business model, for them. You've then also got the time taken to decrypt, which is infinitely longer than the time taken to encrypt. You're also not entirely guaranteed as to where the decryption key will be for the full system. I have seen one claim where actually it was the insured was decrypted on a file by file basis with different keys for each individual file, which must have been torturous, for the insured to have to deal with. And then you've still got the remedial action needed to actually fix the network issues that led to the attack, anyway. And all the while that's going on, the business interruption loss is mounting up. We've already spoken about the dependency that we all now have, on IT itself. So the best way of avoiding that payment of the ransom, discussion is with good quality backups. Make sure they're stored, not offline and away from the network, so that they can't then, be encrypted, as part of the attack. Make sure they're complete. Make sure, that they're up to date. We have had one claim where the insured did iterative daily backups, but then did not do a full backup, at month end. And there are gaps within the iterative backup, so that when they then had the attack, they could not restore. They had to go back to the last complete backup from 18 months ago, which caused a huge amount of pain for the business, and a consequential business interruption loss as well. But at the same time as making sure you've got a complete set of backups, test them. Make sure that you can actually restore from those backups, and actually get yourself back up and running as quickly as possible. So you're minimising the need to manually recreate data. That's only going to be part of the picture, because if we look at some of the losses we've worked on, smaller business, so operating on one site, couple of servers, will probably be, say, 4 to 6 weeks before the IT system is probably back to anything corresponding to business as usual. Large multinational, you could be dealing with 6 months. And as I say, the business interruption loss is going to be mounting up during that period. So back to the preparation. What is the incident response plan? How long is it going to take to rebuild the Active Directory? Make sure that has been thought through. What are the key business applications that are needed from an operational perspective, and that are key to helping the business starting to recover revenues? How long is it going to take to restore those applications and get the backups restored as well? Which vendors are needed? You don't want to be having to make all of those decisions immediately after a ransomware attack has occurred. You're in a crisis scenario. You need to know what that plan is, so when you find yourself in that position, you know what to do. You can hit the ground. You can hit the ground running, and ultimately give yourself the best chance of minimizing that business interruption loss.
Okay. And Mark, sort of from an underwriting perspective, no doubt ransomware attacks have been giving AIG sort of a number of headaches now for some time. Have you had to adapt to your underwriting as a result, and what do you look for when underwriting ransomware risk?
Yeah, I would say, there has been a change in sort of underwriting. I would say it's been taking place over the last couple of years as well. I think it really trying to bring more transparency to the underwriting process, because we would often get questions from maybe a sophisticated CISO saying, look, we're investing, we have a serious cybersecurity budget. We have all this, these investments that are being made. How, is the insurance industry differentiating my risk from another company that may not have the same level of cybersecurity maturity? So there's been a great effort to try to, again, help clients gain more visibility, to understand where the industry sort of views them as a risk. So the things that we've been doing is, obviously one of the challenges with writing cyber insurance is that it's, it's like other insurance, it's done on an annual basis. Well, a lot can change in 12 months. And what we're trying to do is to actually give our customers a visibility so that they can actually log into a very similar underwriting dashboard that our own team would be looking at to see, how is the risk changing. So we have data coming in from over 50 different threat sources. Some that's license data, our claims data, that's all going in. We can take control data that the insured has, whether they have, certain technology vendors that are kind of already plugged in, can automatically populate that so that we can, can see in real time how that risk is changing. And the clients can actually do what if scenarios so that they can say, well, look, if we were to implement this particular control, how would that increase the maturity? And so you can have a much more detailed discussion to say, look, if you get to this point, this is where we think for your size, if your industry where you should be, and and maybe when you get there, maybe there's additional limits or premium reductions or broader coverage that's available. So I think that's definitely a change, and it requires, again, a different approach, right? Where you're actually telling the client, look, these are the top 5 threats that you have today, and these are the top 5 things that if you were to do anything at all, that would have the biggest bang for the buck. And that can actually help the CISO have discussions with the board, because undoubtedly they're doing their own reviews, their own assessments, but having something from the insurer also has quite a bit of value, because we have the unique perspective, right? We have a vested interest in making sure that you don't have an incident, because ultimately if you do, it's ultimately a claim. And you're also seeing carriers be much more proactive. So I would say that we are providing a lot of these services included with the policy. So, one of the areas that we see as a constant area that breaks down is training. So making sure that we have, full training, that you can test the employees, that you can, phish them, see if they actually click on those links, testing them. I think that's very important. The threat intelligence, which again, I think is also very important. So if we can help block someone getting into your network, or an employee clicking on something and going to those links in the first place, that can also help avoid a loss, in addition to doing things like vulnerability scanning and other types of things. And I would say that Census, we are also being a lot more proactive, so that we can see in many cases, because the information that we have, we can see the same level of vulnerabilities that the bad guys would see. So if we see that a client has an unpatched system, or if we see that they have a particular vulnerability or a piece of malware that's beaconing out to a known command and control site, that if we don't act, in a matter of days, they could be hit with a particular ransomware attack. We're now proactively reaching out to give the clients, telling them what we're seeing and giving them opportunity to address that. So I think that's been a big change, and that's something that this is directly from what we're seeing over the past 18 months.
Great. We sort of almost do a sort of webinar in itself for ransomware, as with the other topics that we covered. But in the interest of time, we will move on and have another poll for the audience, if that is okay. So this question: what is the biggest hurdle for existing and new buyers of cyber insurance? Is it pricing, available capacity, coverage is unclear? That should read coverage is too restrictive, or all of the above. So pricing, available capacity, coverage is unclear, coverage is too restrictive, or all of the above. We'll just give you a couple of seconds there, and we will bring up the results now. All of the above, 51%. So quite overwhelming Looking at that, Ben, would you say cyber insurance is a useless product based on that, or is merely has a PR problem?
I think on the basis of the claims that I've seen, those insureds that have had a claim, I think they've seen the value of the of the product. I do think there is a PR issue, and I've commented on this on various occasions. I think that the market there's been an awful lot of PR around some of the high-profile disputes going through. We can Mondelez and DLA Piper and so on, where the comment in the media has been that cyber coverage doesn't pay out. Well, those disputes are not on cyber policies. So I think that there is an awful lot still to be done to highlight what the cover actually does and how it can benefit an insured, to be perfectly honest. And I think the fact we're seeing all of the above, I think that highlights that there's still more education needed to be done.
Mark, is there any comments from you there on perhaps a couple of those topics, pricing perhaps, and clarity and coverage?
Yeah, I mean, again, I think on the pricing side, I think, when the coverage was introduced, particularly in Europe, a few years ago, it really took off in like 2012 when you started to see the first more standalone cyber insurance policies being offered. The pricing was a lot of that was taken from the US, but they was significantly discounted. So at the time, it was sort of like, well, Europe, UK is less litigious. And at the time, you saw a lot of the security, privacy, the lawsuits that were going after breach being one of the main drivers. And so that's why you saw some of that differentiated pricing. But I would say now that, the main driver, and you're seeing a lot of claims. I mean, liability is still a concern, particularly with, as you mentioned, the CCPA kind of coming into effect. But, because we have just this sort of significant number of ransomware, that's causing, pricing, you're seeing pricing going up on this line. At the same time, capacity can also be an issue because, where companies in the past might have been comfortable with putting up, 25 million primaries, we are seeing that start to come down, where you're seeing more 10 to 15 million max sort of primaries, which is what you typically would see in the US. So I think there is sort of this convergence where it's looking more like, again, like a global product, and some of those things where, where the pricing is going up, but it's still probably below what you would consider sort of standard, US pricing.
Great, yeah, thank you. I'm keen to we've got a few questions and I'm keen to move on to those, but sort of just before we do, we perhaps sort of discussed a few topics that create a lot of food for thought for buyers, but I'd like to perhaps turn it onto the panelists and what do you have to think about, what within the world of cyber insurance keeps you guys awake at night, and so perhaps Ben, starting with you.
I think it's more on the kind of the lack of planning and understanding of what the risk that a corporate actually faces, and what the policy actually does. The number of claims that we've seen that have been an outright limit loss, leaving the insured with a significant uninsured exposure. The number of those claims are increasing. So I think the best thing that a corporate buyer of a cyber policy can do is make sure they're identifying what their actual exposures are, model the financial losses of that, and then marry all of that up to both the and the policy wording. I think if that happens, it will make the claims process a heck of a lot easier for everybody.
Great, thank you. And Mark, what keeps you awake at night?
Well, I think it's really just the culmination of all the things we've been talking about here. I would say that in the past, you kind of knew that, okay, now we're focusing on kind of security and privacy type, related incident. Now it's sort of shifting to ransomware, but now it's really everything at once, right? So, and you also have to throw in the whole overall aggregation, and that's really, I think, if you ask any insurer, that's going to be the biggest, that systemic event that ends up, causing losses across numerous policies. And we're already starting to see some of those ripple effects. We've had a few situations where we've had, a specific provider that was hit, where they went, bankrupt, and then you have all those, insureds that had other policies that ended up filing a claim because they couldn't collect from that entity that went out of business. We've seen a particular industry where they were relying on a particular technology vendor that had an incident, and then all of a sudden seeing those claims come in. So I think it's really the fact that, we have to worry about, the first party, the third party, and the systemic risk all at the same time.
Yeah, scary potential. Nuna, last but not least.
Probably two things, quick things. First of all, the regulatory environment. As we talked about earlier, the regulators seem to be taking a very aggressive stance, and I wonder how far that will go and how much it will cost. And then the other thing is whether there is a potential impact on the already challenged D&O market, and whether we will start to see cyber claims giving rise to claims against directors and officers here in the UK, as we've seen in the US.
Great. So we have a number of questions, and we'll try and get to as many as possible. We have a couple in here on, I guess, sort of more around the silent cyber, but also sort of physical damage type element. So you've spoken about property damage caused by a cyber event. Are there examples of bodily injury claims stemming from a cyber event? And if so, is this usually covered? Mark, perhaps you have any comments on that?
Yeah, so on the bodily injury side, we haven't seen those types of claims yet. I think it's one of those things where, again, you're preparing for what's to come, right? And so, and particularly some of the environment that's happening now might accelerate, some of those changes. I think when you talk to, on the liability side and the casualty, I think a lot of the concern there is, again, when you sort of move to autonomous vehicles, how is that all going to work? Where is the liability ultimately going to sit when something goes wrong? And as things become more connected and plugged in with the Internet of Things, that's also where the concern is. And so I think you're starting to see that sort of the questions come into place and the underwriting tools come into place where those other groups that traditionally might have not been looking at cyber exposure in the past, are now going to ask, questions around that, just trying to understand, what could be the potential exposure, and then pricing for that accordingly. I would say, the bigger challenge I'd say on the casualty side right now is that, particularly as you look at the affirmative cyber, is that, historically in some countries they might have had, coverage in there for the Data Protection Act, which obviously when it morphed to the GDPR, kind of increased the liability there. But, and maybe before where it was sort of thrown in because, there was aggregate caps and everything. And now, you're starting to see the industry look at that and saying, well, does that really make sense for that to be in the casualty program? Should that be taken out? Should that be in a standalone cyber policy? So, those discussions are happening now. And I would say our group is really trying to prepare so that as our clients and our insurers start doing some of that more of the activity where things start becoming more and more fully connected, and there is that potential for bodily injury, that they've already have addressed that up front.
Yeah, absolutely. Another question on silent cyber, which perhaps I will take, is with silent cyber no longer allowed following PRA and Lloyd's position, the marine market has found itself with language that provides resultant damage from non-malicious events, but malicious damage is now in essence excluded. What products are available to fill this gap? So the marine sector, I guess, has been one of the industry groups that the cyber market has been quite focused on recently, and a couple of standalone products have evolved from some insurers to look specifically at marine cyber risks, including, as the questioner points out, malicious damage caused from a cyber event. The other option, I guess, is a write back, and so essentially writing back over the exclusionary language on that traditional marine policy. And McGill and Partners have actually looked at one in the cargo space. They have a write back available for cargo and stock throughput programs. And it's something that in the sort of wider marine market is also something that insurers do willing to offer. We also have a couple of questions here on, I guess, of outsourced IT providers. So one here, if a business outsources some of its critical IT functions, as many modern businesses do, does this provide them with additional protection or create issues further down the line in the event of a claim, cyber claim? Ben, perhaps I could turn that to you in terms of outsourced IT claims.
I think I've actually got a claim that has just settled that actually had that exact same scenario that was set out by our questioner. The challenge that the insured business has with the third party is the one that has the ransomware attack. But you, as the insured, you have no visibility over what is actually going on there. You're entirely dependent upon not only the quality and security of that third party's IT system, but also the quality of their incident response. If they get that wrong, then the impacts on your business, that's just going to increase. So I can understand why IT is outsourced, but from an incident point of view, it does create a number of further issues. And I think to one of the other questions that we've got on there regarding subrogation, as well. We've certainly seen some claims where insurers have explored the possibility of subrogating that. I think the particular claims that we've worked on where that has been an issue, I think the claims are still too soon to make any further comment on them, but it's certainly not being ignored by insurers in these particular incidents.
And Luna, just sort of piggybacking on that second question that Ben highlighted, will insurers that try and recover any claim under subrogation, in the event that a third party causes obviously a first party event?
It's always an option that's available. I suppose, given that it's such a new area, it remains to be seen, because it's not as straightforward as shall we subrogate. It's, do people have ongoing relationships? Because often when an insured has an ongoing relationship with a third party, that can sometimes create just a different dynamic. So it probably would be would be on a scenario by scenario basis, but definitely the opportunity is there, assuming they have sufficient insurance to make it worthwhile.
And to Nuna's point on that, where there may be an existing relationship, one of the claims that we worked on, the insured's IT manager recognised that there was potentially going to be a subrogation against the third party, and they just wanted to be kept in the loop as to when that necessarily was going to go litigious, so they knew what effectively the timings of when they needed to transition to a third party. So in that instance, there was very much a close cooperation going on between insurer and insured.
Mark, perhaps I will put this last one to you. It's a bit more a philosophical one. Do you believe there's a dearth of underwriting talent within the cyber market in London?
Yeah, I think that there have been quite a few investments that are being made, and we see a lot of people that again are developing or actively trying to get into this market. I think that we would like to see obviously more training being done. I mean, we've done training for our underwriters where we put them through CISSP training, which is fairly intense, and many of them are going through and studying for and want to take that exam. But we also recognize that as you go across all the different silos, it can be very difficult to make sure that you have that necessary talent in the property side or on the casualty side. And so what we are trying to build out is more of a cyber team that can kind of stretch across all those different silos, sort of horizontally. And so, not only if you can underwrite the risk in a similar way, so using similar sort of modeling tools, and a lot of that can sort of be automated, that can help, sort of looking at it in a similar way. And I think you're also seeing a lot of insurers hire experts, whether that's former CISOs, people that are in the technology space, that are there again to support the underwriter. So that if an underwriter is going through, and again, somebody in the property side is a specific question, they can pull his external resources, pull the modeling capabilities, have a general standpoint, and then ask the experts to say, okay, does this sort of line up with my understanding of the risk? And from there, they kind of have organic growth and some organic learning from that. But I think you do have to make investments both from a underwriting sort of platform modeling perspective, in addition to having those experts that are available that can kind of spread across the organization, because as I mentioned, the peril is going to impact all products, and that's the only way that it can be scalable, is if you kind of set it up in such a way.
We do have a few more questions, but I'm not sure, given the minute left, we will probably do them justice. So we will make sure to follow up with those particular requests after this session. So I guess sort of just a final note from me, if you did like what you hear today, or would like to hear sort of further insights from McGill and Partners, please do visit our website. We have an insights section where we'll be posting firstly a recording of this webinar here, but also you'll have access to other comments and thoughts from across McGill and Partners. So I'd like to thank my panel for some of their thoughts and comments today, and also thank all of you for listening. Thanks and good afternoon.